Good morning. Welcome to YX Insights. Today is Friday, July the 31st, last day of the month. Normally, July is a very upbeat month, one of the strongest in the year. We haven't had a negative July since 2014, but we are not ruling out a negative July this year now, after NASDAQ and SPY falling from their peaks. For Nasdaq, more than 10% after the FOMC being saved in the last session in a bit of a round trip, and we might face even tougher tests in August and September. So usually going into the Jackson Hole meeting, markets can be quite volatile and weak, and especially when the trading floors are thin, people going on holidays, there's less liquidity. So all sorts of fun and games. A reminder of where we are today. So I posted this chart at the end of May, basically warning that we could have a parabolic rally that is followed by a steep decline and increased volatility. And after I posted that initial chart, basically semis as a sector chopped sideways for over 6 weeks or so. And we are basically now seeing the final cracks of it. And this chart compares where Micron is today versus ARK in 2021, when the post-COVID growth bubble burst, and also silver from the year earlier this year. You can see that parabolic rallies tend to follow a very similar sort of steepness and trajectory. We tend to get a little pause in the final run-up, but in the last month or so, things just go vertical, more than doubling in the case of Micron. And what we tend to see is that because volatility expands from here, the declines tend to be equally sharp. So it can go from something like 700 to 1,100, and then it loses 30%. And for other stocks, for example, Sendix, it has lost more than half its value. And then we have very volatile ranges subsequently, followed by lower lows and lower highs, and very choppy waters in the following month. As you can see, silver still hasn't really found a bounce, whereas ARK had really big attempts to recover, but 5 years later, it's still trading below this high. So I know the narratives tend to differ every single time, but the trading psychology remains very similar. People pile in and start chasing, and using leverage. And when the tide goes down, those who are not wearing swim shorts become more obvious. And that is the case of situational awareness, what a great name for a hedge fund. So the news of yesterday is that situational awareness, the boy wonder, the 24-year-old Leo Aschenbrenner, has basically been stopped out. His book was 4x levered, and he was up a gazillion percent year to date. But in the latest four, he was long companies like Sendix, which has halved, and Bloom Energy, which has also halved recently. And you can just imagine the decline on that. So he sold his entire public book, so all his public equities, to Citadel. So good old Ken Griffin has bought his entire book in one go, including the long and short legs, which actually does make sense. People feel outraged because it's such a big number, 20 billion. But when you do a block trade like this, you don't really want to have 5 other buyers involved who might dump on the assets you just bought as soon as they receive it. It's actually much better to warehouse the risk if you can, and slowly distribute over time if you don't like it. So we saw a massive sell-off in the past week going to the FOMC, and then yesterday a vicious rebound right after the situation awareness book got sold. They're still holding on to the private stakes in Anthropic, which is probably still doing very well. I think one thing here is we are not trying to really dump on the latest loser, etc. What I have observed, having gone through multiple cycles from 2018, COVID, and even late last year when a lot of high beta names fell. I think when things are going well, you can feel really invincible. You can really feel all the theses are working, and you just want to increase your risk. But that's probably exactly the wrong moment to do so. So a lot of people, instead of taking profit, they would actually try to add risk and chase the momentum, add leverage. And I think when you have a number that shows that backtest suggests, volatility is X and drawdown is, let's say, 20, 30%, and that's all within your risk parameter, you have to bear in mind that so for something like Sendix, it goes 10x in a year and it hasn't really seen a pullback. So the back tests don't really work very well. And if you have a parabolic rally that has never been seen before for, let's say, 10 years, or even 20 years going back to .com, it is really hard to model that and just blindly trust your model in terms of your risk sizing. So in some cases, the experience and the common sense and your knowledge from other sectors outside of your main book, in this case, we're looking at ARK, we're looking at silver from the chart before, will actually help you a lot in risk managing and understanding that actually there are some common pitfalls that apply to all trading periods, to all the rallies that you're chasing, and it might not end well. So I do think that is a really important lesson to be aware of. And I think there's one thing about knowledge and intelligence that can't substitute for wisdom and temperament, which to me is much more important for longevity in both trading and investing. And you could be at the right, and also the perceived intelligence is all often amplified by being at the right time and the right place, and being under the spotlight for that, than having actual a long record of consistency, which is a very much higher bar. Now, looking at the FOMC, which was a very key event this week, of course, is Kevin Walsh's second meeting. My main takeaway is that so they've kept the rates on hold, and Kevin Walsh has acknowledged that the market is basically predicting future hikes, and he's not really going against what the market is saying. And in fact, if anything, he's leaning into it. And we have three dissents this time. Three people wanted to hike rates, which wasn't the case before. I think the Fed now really wants to lean into a smaller Fed, a quieter Fed, and letting the bond market do the talking and heavy lifting for them. And actually, what he's trying to do is to keep clarifying the goal of 2% inflation. It's not 2.5%, there's no soft target, etc. But very quiet about the forward guidance on how the Fed wants to achieve that, whether it's through QT or rate hikes, etc. He's giving the market the target, but he's letting the market figuring out what is the right path to it. And I think instead of leaning on traditional economic models, he's trying to lean towards what the market thinks is the right solution. And in a way, that's also quite clever, because he was appointed by Trump, who was really annoyed that Powell didn't cut more rates. And here, I think he's leaning towards an approach. Also, with Scott Besson, an ex-hedge fund manager, as the Treasury Secretary, where he's saying, let market do the talking, and he can elevate some of the responsibility if the market gets it wrong. And I think that is almost like an answer that the Trump can probably accept, because it's not really him going against everyone else. It's just the Fed is trying to take cues from both the data and the market rather than just the data alone, and trying to tell the market what to do. So in this session, while he's mentioned growth a few times, I think this is slightly misleading because he's actually saying growth is really robust and labor market is really strong. He's actually not that worried about keeping rates high. But the important thing is that inflation is still the front and center of the Fed concern. Now, we've had a couple of big earnings reports. So I'm going to cover Meta and Microsoft. We had Apple results yesterday, but we're just looking at market reactions today. We're going to cover that later. So for Meta, Meta's price dumped after its earnings. So is showing a 28% increase in revenue, which was basically expected. But the problem is that the operating margin fell, and the free cash flow margin also fell. And the profitability metrics fell because of two reasons. First, in the recent years, Meta has been spending heavily on CapEx. So now some of that depreciation is coming due. So in terms of the actual P&L margins, that accounts for about 1.5 to 2% decline. And the rest is the legal expenses, severance expenses from the recent quarter, from the layoff, etc. And if you strip out those one-off items, the operating income would actually increase by 9%, which is still not that high, given that revenue went up by 28% year on year. So there was still a squeeze in the margin. And I think at this moment, investors are slightly disappointed in a way that Zach is spending a lot of money. If you look at the free cash flow, we're basically flat on the quarter, and we're going negative next year, which you'll see in a second. And the capex is about half of revenue, and that's still going up. The investors haven't got really clear answers whether all of this effort here is actually going to translate into durable and more sustained revenue increases and profitability, especially that given that there's going to be a depreciation wall from the previous capex spend. So depreciation could rise from 9% today to 20% in 5 years' time. And that all of that is going to eat into the profit margins. And also Zuck is doing a bunch of side businesses like the AI glasses and etc. That's not really making a dent on the revenue front. And so spending a lot of money, not seeing a lot of returns right now, and investors are just not really sure whether this is the right approach. And the dilemma with the hyperscalers today is that, and if you're not spending enough on AI, you could fall behind the competition, given how fast things are evolving. But if you spend too much, then you are basically repeating the railroad bubble or the dot-com bubble. You're basically losing money on your returns. So getting that balance right is extremely tricky because the forward projections are very fuzzy, and a lot of things you can't really accurately predict exact demand that will be driven by this because it's such a it's a new, again, I mean, it's been 3 years maybe since we've had ChatGPT 3 and everyone's becoming more aware of AI, but it's still very new in terms of the trajectory of how things are going. So it's almost impossible to predict accurately what's happening. And that's actually why Zuck hasn't given a precise number on the capex for next year, because he's trying to say everything is predictable. And also he's quite in two mind on whether to use all of the spare compute he's got for his own business, or turn it into a resale business. And because now the computer is worth more than what he's paid for, he can kind of offload it at a profit. But again, that's not really a sustainable revenue strategy. That's almost like trading, and at some point you can run out. So I think there isn't a really clear, coherent strategy from Meta, and the predominant revenue stream for Meta is the ads, so volume times price. So the AI can help increase the impressions, which is the volume of ads, and if they can convert better, then you can increase the price of the ads. But at some point, there is a saturation, and they're really pushing that saturation point hard. So if you look at the forward estimates, so this is the NTM next 12 months versus the last 12 months. So last 12 months, 28% growth. Next 12 months, 21% growth, even though we're spending loads of money. And free cash flow, basically current margins 18%, last 12 months. And next 12 months is going to go negative. CapEx as a percentage of revenue is 39%. And it's going to be 64% in next 12 months. So that's still pretty aggressive number. That would really keep investors anxious. We have seen Zuck U-turn from his strategies before, after he renamed the company from Facebook to Meta and started doing the metaverse stuff. The stock tanked at like 80%. And then he U-turned the strategy, got his act together, and the stock almost 10x. So we've seen him capable of pivoting. So he's definitely capable of doing that. We just don't know when that push point will come. Looking at the valuation, Meta is trading against the 5-year history. Meta is trading below its median EV sales, but within the 1 standard deviation. So it's just around the median mark. It's trading at a low point versus post 2023, so 2024, 2025. But if you look at the bear market here, there's a lot room lower in terms of the valuation. And if you look at the EV versus free cash flows, is actually quite expensive because the cash flows are declining. As you can see here, PE, EV sales, EBITDA all around the 20th, so the bottom quartile. So that means cheap, but on a free cash flow basis, is in the top quartile, which means it's quite expensive. One method we can use is to look at the fair EV EBITDA multiple for Meta. So we're looking at the past 5 years and how well EBITDA growth translates to EV EBITDA multiple. And what we find is that given this regression, the fair multiple value is about 15x, and the conditional mean is 15.7x. So let's just use the average here. That does imply a significant upside, which is 75%. But again, this is not really based on free cash flow. This is based on EBITDA, and unfortunately, the free cash flows are going to be negative. So that would drag the valuation down, and also the depreciation is rising. So that's, you could argue, is also quite relevant. So overall, I would say that I don't think Meta is overly cheap yet, but it's probably not a short candidate either. So I'm quite neutral here. Looking at Microsoft, so Microsoft actually received a positive market reaction after its earnings. So Azure accelerated to 43% and guiding to even higher growth next quarter. And something else that they've done is that they've extended data center useful lives to 25 years. I think the investors like this for two reasons. So first, you're seeing less depreciation over time. So your P&L, the bottom line is being hit less when it comes due. And secondly, it could signal that they're willing to slow down on the CapEx spend going forward because now they're realizing the money can stretch a bit further on what they've spent already. What I think this triggers is if you are familiar with Michael Barry's argument recently, he mentioned that a lot of these hyperscalers are basically cheating their P&L by revising the useful lives of the data centers, etc., by extending the useful lives of chips from 4 to 5 years or to 6 years, then you can depreciate less. So in a way, that's more of an accounting trick. And if you look at what the CEO of Microsoft said in his interviews, he's saying that he's got a bunch of chips, let's say from NVIDIA, but the next generation comes in a year's time. So yes, you can still use those old chips, but they're far less efficient versus the new ones. And they require more energy and all the subsequent stuff around it. And therefore, actually, it might make sense to migrate to the new ones. So in effect, yes, technically, the chips can last for a while, but realistically, you are really not going to use that in terms of its economic value. So I do think Michael Barry has a point there, and therefore I am treating those headlines with and revisions with some skepticism. Just looking at the actual revenue growth, so 18%, that's very similar to the past 4 quarters. So there is no meaningful acceleration from the AI yet. The margins are holding pretty steady, so this is not as worrying as Meta. If in any case, the net margins and free cash flow margins actually went up versus the last quarter. Still, while we're seeing free cash flow generation, that's declined year on year in terms of growth, and capital expenditure is still rising, now 40% of the revenue. Looking at the forward guidance, so the 15% next 12 months versus 18% last 12 months, I think this is probably a bit of a sandbagging, is a bit low. We probably could expect something like 17% or even 18% going forward. And the free cash flows, so I think this is important. This is still positive for the next 12 months. It's going to be lower than what is produced this year, but it's still positive versus Meta's negative one. And the capital expenditure, it will again rise to half of revenue versus 35% on the last 12 months. So overall, I think the market reaction is probably a bit more optimistic than what I can see from the actual report. I think one argument one could have is that Microsoft is more full stack. So it actually has the application layer, which could receive the ultimate benefits from the AI build-out. And looking at the recent strategy, they've also decoupled from ChatGPT, from OpenAI in terms of partnership. So Azure is now built to be fungible in terms of what models one can use. And Microsoft is now actually more focused on substitutability. And actually, they've mentioned specifically in the earnings call that about the recent attack from OpenAI. So one of OpenAI's AI agents escaped the sandbox environment and attacked ARKK in the cybersecurity breach. I think they've done one more as well. I can't remember what the other one was. And that highlights the risk that if you rely on a single model, there is also like a key model dependency risk. So looking at valuation now, so again, we're trading around the median for the past 5 years. Yes, the low point since 2024. So past 3 years, we're trading at a low point, but it's not low versus the bear market. And in terms of EV free cash flow, is still quite expensive because free cash flow is declining. So for me, I think, again, Microsoft is quite fairly valued at this point. So here we're looking at the EV versus sales, because this is the metric that has tracked best in the past 10 years. I looked at EV EBITDA, EBIT, and PE ratios. They don't really have strong association between growth versus the multiple. Whereas this one, EV EBITDA, EV sales is probably doing the best. Our fair value is basically where the price is trading today. Now, moving on to the charts, I'm looking at SPY. So we had two small sell-off early in the last month. And actually, the recent sell-off hasn't been as aggressive as you would see elsewhere because the semis are less and big tech are slightly less dominant in SPY than in QQQ. But still, we are struggling at this 50-day moving average. So today, it seems like we're trying to reclaim it. But if we can't after the open, I think we could test the 100-day in one more flush going into August. And looking at QQQ, we are due a rebound. So I wasn't too surprised by yesterday's rebound. So if you look at this S1A sell-off versus the S1B sell-off, the S1B sell-off reached 125% extension of S1A. So naturally, there is a bit of a sort of like a support coming in here. Granted, this was actually a bit deeper than I thought. I did think that they could defend the 100-day moving average, but there was a head fake down here. And I would expect a rebound here to retest the 50-day moving average, which is also the same area as this high volume profile. And looking at the general momentum, there's a good chance it gets rejected, but we'll cover that when it happens. We'll see what happens next week. So IWM is tapped the bottom of this price channel. So S3 reached about 90% of S2, and S2 was just slightly short of S1. So I would expect a rebound here, and it's actually not come that far off from the autumn high. So challenging the autumn high is probably not ruled out. However, if we do get a concrete signal that the Fed will hike near term, which the market does suggest so, but if the Fed follows through on it, I think IWM could be at quite grave danger because it's more sensitive to the high interest rate valuation pressure. SOXX semiconductor head and shoulders pattern broke down here, broke down the 100-day moving average, but we saw a nice bounce yesterday, now challenging this neckline. So I think this region is actually going to be quite difficult to progress. We have the 50-day moving average, high volume region here. So a lot of people would want to offload at break even if they bought the dip previously here. And also this is the neckline resistance now. So this area I expect to be quite difficult to clear. So stocks can try to move up with QQQ as well into the 50-day, and we could still get one more downturn afterwards. IGV. So IGV is looking at it is looking quite neutral to me because I am actually expecting a potential rally two here. RGB tends to hold quite well when semis weakening due to rotation. And it's the whole debate about the picks and shovels trade versus the downstream application layer. So it is stuck between the key moving averages. So over here, there's not really much to say. We just want to see it break above the 200-day moving average to reconfirm that we are moving along this R2. And R2 at 100% of R1 would retest the all-time high. So that would be quite nice. So Bitcoin, so I'm a bit neutral here for Bitcoin again. We haven't broken the June high yet. And actually in June, we made a lower low. So all of this, while we did see a rebound, and I think the 50-day moving average isn't really relevant that much in this entire sell-off. I mean, we moved past it a couple of times and it didn't really mean anything in terms of the overall trend. So my bias is still that the risk leans towards the downside here rather than the upside. So I'm still very careful on how it could do. But it's getting close to the 100-day moving average. If you can move decisively above it, it could change my mind. Previously, we attempted and couldn't make it, and that resulted in a bigger decline. So that's definitely the real test in the near term. Looking at ETH, so ETH has fallen about 75% of this sell-off, which isn't really sufficient in my view for the final capitulation, but it is maturing, let's just say. So looking here, we broke out of this range bound, so we broke above the June high. So that is better than Bitcoin in terms of relative strength. And we're challenging the 100-day moving average. We haven't managed to do that, but still, even if we do, as we did before in April, I'm still mindful that this could be a bull trap. So the 200-day moving average for me is probably the decisive factor here. Coinbase, so it is making a head and shoulders pattern near term until it breaks down. I'm not decisively bearish yet. So I have seen patterns, for example, Microsoft bouncing off its support, and we can't rule out a decisive rebound towards the all-time high before it breaks down. But the thing is, it is trading below the key averages, so I think it's probably not right time to hero it. If it breaks over the 200-day, as it comes down, I think that would be quite a nice entry point for with a stop at this stop loss here, at this support here. MicroStrategy, we had a head and shoulders pattern. It broke below this support, and now it's retesting it. It's below all the key averages, so it does look much more bearish. If we repeat this fall from the top, we could actually test 39. The thing with MicroStrategy is that it's not very clean in the sense that over here it was trading at 2.5 or even 3x NAV, and now we're back to about par. But because of the recent concerns on liquidation risk for Sailor, it could even trade below par. So it doesn't have to follow Bitcoin. Of course, if Bitcoin starts rising, it will reduce the pressure on MicroStrategy, but Bitcoin could actually just go sideways or go just slightly lower, but that could cause a much bigger fall in strategy. Robinhood, so we've seen Robinhood making massive rallies before that were similar in size to each other in terms of percentage gains. And each time a reliable indicator is the 50-day crossing over the 100-day moving average here. And we are seeing that here now. We've seen a crossover recently. but it's not broken above this sort of support and resistance line yet. I actually don't mind having a entry here with this low as a stop, but targeting the 100% of R2, which is what R3 achieved. So if we do replicate basically R2 and R3 in terms of percentage gains, we could actually target 300, which will be a tripling. It sounds like a lot. It could take a while to get there. We could only restart after we get towards the year end. But we've seen Robinhood doing this a few times before, so I definitely wouldn't discount this possibility. GLD, so not a lot has changed since my last update. We've seen 3 repetitive sell-offs that were 100% of each other in terms of percentage losses. So I am expecting some sort of relief rally that we saw over here and over here to test the 200-day moving average. Doesn't mean it will break above it, but I think it will start moving towards it. So tactically, I think we can look for a rebound here. Silver, similarly, we have 3 sell-offs. So this third sell-off is 100% of this initial sell-off, which was the capitulation at the top. And we are holding this kind of support line that used to be resistance. So again, like gold, I am looking for a rebound. I think we should be able to test the 200-day and this high volume region, even though in the near term it has just been consolidating sideways. There isn't a clear catalyst. But what I would say is that historically, when equities start to wobble, there has been rotational moves towards safe havens like gold and silver. So that could be the catalyst for the next move. Copper. So copper, our signals have turned even more bullish recently for copper. And what I would say is that if you just look at how it rises in each rally, so since 2024, it's remarkable that it has a very rapid rally each time, followed by a very rapid drop as well. And the rallies look pretty similar to each other in terms of length. So actually, if you trace back even further, this R2 was 100% of R1, and R3 was nearly 100% R1, R4 is 100% R1, R5 reached 125% of R1 on that single candle. But if you just discount that to that candle and just look at this overall range, that was 100% R1 as well. So if we follow this pattern, let's say we get 6 times lucky, we could be aiming for 44. So that's about 10% higher. So it doesn't look like the rally is done here. And of course, strict risk management is needed for commodities. Looking at Apple, we had earnings last night and we're seeing sell-off. So I think technically speaking, I'm not that surprised because we've had a R2 that was pretty aggressive. It's reached almost 100% of this R1 in a much shorter space of time. So, and it's going above the previous resistance line. So I'm not surprised that it's coming back. I think they had weak results regarding services in China. But the real test begins usually around the holiday period, especially after the announcement in Q3 for the new iPhone lineups. The most anticipated this year is the foldable phone. So if we, and usually what people do is they start measuring the lead time for this new lineup and to see if there's high demand and therefore better results. And so between August and the holiday season, just shy of December, is usually when Apple outperforms. So if we get a retrace here, I think towards end of August, early September is probably a nice period to start accumulating again. Amazon higher now. So after the earnings, again, I'm looking at the repeatable patterns of this rally. We had R2 basically at 100% of R1. We rarely spend that much time in the bottom half of this channel. So 41 days over here and 42 days over here. It's basically 2 months. And we are looking at the potential completion of R3 next towards 320. So that would complete a quite nice pattern for those three rallies. Google, so Alphabet, I think we might have finished this sell-off here. So I've highlighted before that this S2 could replicate 100% of S1, and it did reach that at the 20-day moving average right after the earnings. So that's pretty good. There's also a high volume profile here, support. So I think, of course, this is still a downtrend. So you can't say we have started an uptrend already, but just looking, so we're still within this downtrend range, but just looking at the depth of this sell-off, that downside move has matured. So I'm looking at how it interacts within this channel and above the 50-day moving average. Meta, so we've just covered the fundamentals earlier, and just looking at the wider picture, we have this channel support going back to 2024. It sort of broke yesterday after the earnings, and we're trying to retest it. But just looking at the near term, so this R2 was just shy of 100% of R1. It's definitely finished now. And we're looking at the relative length of the sell-offs now to see whether our latest sell-off is complete. So we've had S1 going from the top of the channel to just kind of like the middle and slightly below, and S2 going from the top half to the bottom of the channels. They were similar in length, so 100% of each other. S3 was 75% of S1 and S2. This was a smaller sell-off that held this low, but now we're looking at S4. It has reached 100% of S3. So this decline here was basically the same as this decline here. So we've reached that target. So that initial sell-off definitely has matured. The only question is that because S3 was quite shallow, S4, if completing at same length as S1, S2, could go down a bit further to sub 500. And over here, I think there's no point trying to be a hero to call whether we bottom or not. It's just easier to see how it consolidates valuation-wise. I'm not really minded either way. So for now, I'm basically in the sit and watch mode. Microsoft. So I was more underweight going into the earnings. I did think this was a head and shoulders pattern, and I was leaning towards a more bearish stance because it made a lower low here, and that's just around the neckline. So I did think potentially we could sell off into 300. We didn't get that in one go. We've had a rebound since. What's notable is that this rebound here, the R2, is now at 100% of R1. So these two lines are equal length. So you think about them in percentage terms, this rally was same as that one. So then previously we did break above the 200-day moving average and then move back down. So how Microsoft interacts from here onwards against the 200-day moving average will be key. If we if we can't get a follow through on this, and we start going lower, I think. So this is the resistance line from the top. I still think this sell-off too is on the table here. So I'm not convinced of an overweight bias yet. I'm still leaning towards fading this rally than embracing it. NVIDIA, just zooming in here, this is an head and shoulders pattern here. Or you could even argue that this was a decisive head and shoulders pattern and that got broken down. But I think the original position probably looks a bit better. If we fall below here, which is also the 200-day moving average just above, then I think NVIDIA is in big trouble. And we're looking at a potential sell-off. You love this very scientific way of looking at targets. That points to 171, which is the bottom of this consolidation range. Tesla has reached my S2 target actually. So S2 100% of S1 was 300, which it achieved. So I've been shouting about this for a while, since end of May, I think, because I wasn't convinced that this rebound was bullish enough. And it's now come to fruition, and I'm happy to basically move to more neutral stance. I think this sell-off has matured. Of course, you could easily extend to something like 125%, etc. But over here, I'm not really chasing the downside. With Tesla, you have to bear in mind that it's not really valued as a car company. If it's valued as a car company, its market cap will be worth something like 20% of what it is today. And the other 80% is actually really the robotaxi forward projection is like an option premium on that. And the valuation of that option can swing a lot depending on the timeline of the rollouts and regulatory pressure, etc. And I think Elon is very good at showing narratives and kind of stringing Optimus robots into the story as well for continuation of the total addressable market expansion, and therefore justifying the high premium. I'm going to quickly go through the semis now. I'm not going to go into too much depth, but for AMD, essentially, I do think this move has matured. R2B is 100% of R2A, or nearly 100%. So there isn't that much of an upside case from here. And from here, it hasn't totally broken down, but I can see the beginning of a downtrend. So I'm quite wary of selling the rally pressure here, especially given the volume that's building here, which couldn't push the momentum further up. That means it could be distribution here. Broadcom is probably one of my favorite chip stocks, because I think the valuation is quite fair, and a lot of companies, hyperscalers, are now building their in-house chips that's more application specific, which threatens NVIDIA's dominance, and that would benefit Broadcom. So if we have started R2, 100% of R1 would target just under 600. So that's a decent target. And the only reason I want to be a bit more patient is that we're stuck at this moving average cluster. So it's actually not easy to say whether S2, the sell-off, has completed. I think it probably has, but with the broader semiconductor sell-off, you never know. It could just have one more leg lower, but it's held quite well given the broader sell-off. So I'll be a bit more optimistic on Broadcom than other names. Marvel, so Marvel basically broke down from this topping structure. This is small head and shoulders, which I highlighted 3 weeks ago. And now we're in basically a downtrend here. We broke below the 100-day moving average and now trying to reclaim it. But historically speaking, once it breaks below the 100-day moving average, you tend to get to 200-day moving average quite quickly on the downside as well. Over here, over here, over here, over here. So I wouldn't be surprised if we test the 200-day moving average next. So my verdict is more of a bearish bias. TSM. So TSM is probably one of the better names to own. And if you look at in terms of its steady climb, it's now retesting the 50-day moving average, but it's held its upward trend channel quite well. It didn't go parabolic in the past couple of months either. So it's been a nice climb, but it wasn't like a vertical curve. So if I were to buy the dip, I would probably favor TSM and Broadcom over here. Micron, so I'm a bit less optimistic on Micron. First, of course, it went parabolic from 300 to 1,200, so 4x in just a quarter. And in this sell-off, naturally, is going to be quite wide as well. Looking at S1A, touching the neckline here of the head and shoulders pattern. So if we reproduce this length here, we're touching 650. So I think we could sell off to 650 and find a rebound. I know that it's bounced quite hard yesterday, but we're still under the 50-day moving average. So this still could be a head fake. Qualcomm. So I think Qualcomm is the most textbook chart I've seen so far. So two things. First, this rally here from the bottom of the channel to the upper side of the channel replicated almost perfectly of this R1 rally here. And then we showed a head and shoulders pattern, the right shoulder being lower than this, suggesting momentum has faded. And then we're seeing three-leg sell-off since the top. So S2B is same length as S2A, as S2C has reached the same length as S2B, which is also S2A. So this has basically played out very textbook and is matured in terms of the sell-off target. I'm not surprised if we get a rebound, but again, there could be a S2D and slow sell-off that moves all the way down to the end of the channel like it did before. Intel, so looking at Intel, it broke below this support line and as well as the 100-day moving average. So this becomes the new resistance. Again, historically, if it broke below the 100-day, it probably test the 200-day as well. And the only exception was probably over here when it just bounced off and rebounded in a couple of days. So Cisco, I think Cisco is also looking quite toppy. We're at R2, similar to R1, R3, 125% extension of R1. And then R4 is clearly a much more vertical rise. That was 100% of R3. And now we're seeing a potential breakdown and a U-turn in terms of this trend. We're below the 50-day moving average, unable to reclaim it. Over here, it does look like distribution. And to fill this gap here, we'll test the 100-day moving average. Moving to SanDisk. So SanDisk technicals were amazing up to basically 2 weeks ago. And this, again, the problem of trading a stock like this, when you have a parabolic run from 50 to 200, so that's 40x in basically a year, your model's not really going to show you where it could where it could draw down. And once this move exhausts, it moves rapidly from 2,300 to 1,500, which is almost like a 30% move in a short period of time. And that just looks quite normal on the chart. And now we're at the 977 in the lows, which is less than half of the peak. And that doesn't even look aggressive after a 40x move. So if I chased over here, even if I set a reasonable loss stop at the bottom of the channel, it's still quite a wide range to draw down. And that comes with the volatility and the inherent risk of chasing a name like that. So I really urge everyone to basically assess the risk in volatility terms and understand that position sizing is quite key, because the only thing that could really protect you here is position sizing. So if you have something that's moving more volatile towards after a 40x run, getting a massive position in it could really wipe people out as it did for situational awareness. CoreWeave. So this is a breakdown pattern S2. The 100% extension of S1 with point to 50, and that's a massive decline from its peak as well as this local top here. But I think it's very likely now it's below all the key moving averages and it's made a new low versus December. So the path of least resistance is downwards. NBIS. So I think interestingly, I was bearish here as it crossed below the 50-day moving average, retested and fell further down, but actually got quite close to the 200-day moving average, which it did here. And looking at the decline here, this S2 is at 100% extension of this S1, so equal length. So I think the sell-off has matured here, but it doesn't mean we will get to all-time high straight away. It did spend some time consolidating here. So I did warn that after breaking down from this head and shoulders pattern near term, there's a risk now it challenges the bottom of the channel, which it now has. Also, it's filled 80% of this S2, the S2 target, which replicates where it did in S1. So I think most of the sell-off is probably done, but I wouldn't rule out a further consolidation. PLTR. So this is definitely a downtrend still. We haven't managed to even reclaim the 50-day moving average. It's tried for a month and still failed. So looking at this decline down to here has completed 80% of S1, but it could go down further to test 100. I think the momentum is just not with PLTR right now. Oracle, very tricky spot. It lost the neckline here and it just kept on falling. Looking at the extension though, so we haven't seen a reversal of momentum just yet, but if S2 replicates the 100% of S1, we could challenge 97 here. But having said that, it has matured in terms of the sell-off, so I'm being a bit more neutral than before. CRM. So CRM is seeing still like lower lows and lower highs in the broader downtrend. So we can still point towards S3 completion at 130. ServiceNow. I think ServiceNow is probably more interesting to look at because we could be replicating this rally here, and 100% would point towards 160. 200 days is definitely the important resistance zone. The fact we have a higher lows here gives me a bit more comfort that maybe we bottomed in S2 and we don't have an S3. It's just we can't rule it out until we've crossed this mark. Adobe, so S2C has basically completed 135% of S2A. That's similar to S2B, but it's just slightly shorter than S2B. We did touch the bottom of this channel. So again, like ServiceNow, this could have bottomed, but below the 200-day moving average and within this channel, it's not really a breakout, so we can't really confirm that just yet. Netflix, I think Netflix is quite interesting. We broke below the neckline. The S2 has reached 100% of S1 and is now retesting this neckline. So what I think it could do is that it could actually try to rally and retest the 50-day moving average or even the 100-day moving average, gets rejected and have one more low in S3 to complete the entire structure. Uber, unfortunately, I was leaning towards more of a tactical rebound here, but it's not happened. Broke below this trend line. So now it's looking quite tricky, also below the key moving averages. So I'm moving definitely a bit more neutral. Rocket Lab, I used to really like this name, but it basically ran ahead of itself, peaking at 150. I think this R2 has completed against R1 in terms of length. We've fallen below this channel, also below the moving averages and the volume profile. So I think it's in a bit of a wilderness now. It could test 50, which is the next volume band. Basically, we want to see consolidation first before hero calling the bottom. Again, Space Mobile as well. We basically saw a double top that became a resistance. And now we are below all the key moving averages. We're seeing a death cross recently as well. So over here, I'll just prepare for a downtrend and consolidation before getting too positive. SpaceX had a nice 3-day rally after the IPO, and now we are down to 112. And actually, I did see this being the potential target because 100% extension of this initial sell-off points to 110. So we're basically there. So this move is basically mature now, and I want to see how it consolidates. So that's it for this week. Thank you for joining, and we'll speak again. And this background, I've been on holiday in Tenerife recently. What nice water park there, highly recommended. So I thought I might share this experience with you. Thank you.